This Week in Startups is brought to you by Wistia. Create your free Wistia account today and get started hosting your videos in just minutes at wistia.com/twist. And Aero, the world's first home mesh Wi-Fi system for free overnight shipping. Visit aero.com, EERO.com. At checkout, select expedited shipping, then enter promo code TWIST.
Hey everybody, welcome to This Week in Startups. I'm your host, Jason Calacanis, and this is the show where entrepreneurs come to be inspired, to hear stories about entrepreneurship, starting companies, building products. And we usually have guests on who are angel investors or venture capitalists or entrepreneurs. Sometimes we do a news roundtable, but one of the things people like to do is ask me questions as an angel investor and as a founder and somebody who has done 700 episodes of This Week in Startups. They like to ask me questions. So we do a Q&A once in a while, like once every month or two. And I've got 22 questions here. We're going to answer some of those. And then we're getting a bunch of questions in live from Facebook Live and YouTube and Twitter and our Mighty Bell community. If you want to join the Mighty Bell community, it's community.thisweekinstartups.com. You just sign up, we approve you, and then you can come talk to 900 members of our community who like to talk about startups 24 hours a day. Okay, so I'm going to do our first question here. And it says, this is from Alexandra, and she asks a very common question. For those of us currently engaged in day jobs, is there a way to passively support viable startups and potentially reap profits from doing so? So this is a great question. You're working, you're full-time, you've got kids, you've got a family, you've got rent, whatever it is. You're not able to participate in the startup ecosystem yet, but you're interested in it. Great question. There's 2 or 3 different ways you can get involved. One of them is you can be an angel investor in startups. Now, there's 2 different types of people in the world, accredited here in the United States, accredited investors and non-accredited investors. An accredited investor has to have certain thresholds in terms of how much money they make each year, a couple $100,000, and how much liquid net worth they have, a couple of $1 million. And then there's non-accredited people. Non-accredited people are everybody else, 96%, 97% of Americans who have under a couple of $1 million in liquid net worth. That means cash in the bank. You can, if you're one of those individuals, go to sites like Republic, Seed Invest, and others, and invest in companies. Now, traditionally, those companies have not been the strongest companies because if you raised money from an angel or you had your own money or a venture capitalist, you didn't need to go raise money from a syndicate. But now AngelList and Republic and Seed Invest and all these sites are starting to allow people to angel invest as little as $500 in a company. So that's one way to be involved. Another way to be involved is to take your unique skill set and offer it to startups. So I would, if I was a designer, go to different demo days and meetups and look for the companies who are working in, getting their angel funding or just coming out of an accelerator. Those companies actually need help. If you were a designer, you could go look at all the YC, Y Combinator, Launch Incubator, 500 Startups graduates and just start emailing them and say, I looked at your site. I think you could use a design refresh. I was wondering if I could redesign your site in exchange for equity, because I'm interested in the startup world. I'd love to get together. And by the way, here's my portfolio. I bet you if you email 10 people and you offer your services for equity, whether they be copywriting, design, sales, et cetera, you might just find a company that needs your help and be able to trade your sweat equity for their actual real equity. Now, most companies fail, so you're going to want to do that with a dozen companies over a year or 2, but it could work out for you. And if it doesn't, the worst case is you've built up your portfolio. It's one of those things, getting involved in startups means you're going to be giving up the steady paycheck. That's what the Googles of the world or the Goldman Sachs of the world offer. They give you the steady paycheck, ridiculous benefits, and then they eat your soul. And on the other side, you have startups which make you, have creativity and you might find more fulfilling and there's more offered to you to do and you probably have more responsibility and it's more engaging for a certain group of people. If your life's on cruise control, and you want to punch a clock, go to Goldman, go to Google. That's why they have the joke about Google in the Silicon Valley series, Hooli, that you can go hang out on the roof and do nothing, because people do go to Google and do nothing. They just hang out because they have so much money. They can just hire people and give them huge salaries to do nothing. You have to be pretty smart to get in there, though. Okay, great question, Alexandra, and I hope you dip your toe and then eventually jump in the pool. Okay, we're going to do another question. Hey, everybody, let's do another question here. We have a question from Christopher, who's in the This Week in Startups community, which you can join, community.thisweekinstartups.com. It's free. And Christopher asks, I recently read a very enlightening article on Medium. I'm an investor in Medium.com, very cool company, about VC fundraising. Basically, the concept was stop sending your deck around, stop meeting with associates, those are the junior level people at a venture firm, and only spill your company secrets to named VC firm partners. And all that matters is getting this initial VC meeting. In this initial VC meeting are TAM and traction. Thoughts? It's an oversimplification, but what you explain here, Christopher, without knowing who wrote the article, is not completely true, but generally trending towards true. I'll break it down for you. If you are going to try to raise venture capital, raising venture capital is very hard today. You need traction. And if it's an enterprise company, you're looking at, let's call it $100,000 a month in MRR, monthly reoccurring revenue. So at least $1 million a year, but probably more likely $2 or $3 million a year in revenue for a venture capital firm to want to invest in you. Or if you're a seasoned entrepreneur, which means you've done 2 or 3 companies, you've sold 1 or 2 companies, and you've made other investors money, and you're notable, or you came out of a large company and you had a senior position, so you were the VP of product at Twitter and you're starting a company, it is possible in those scenarios to just raise money from a venture capitalist because you're a known quantity without having traction. Yes, someone like Kevin Rose or Stuart from Slack or Mark Pincus or Evan Williams from Medium and Twitter or Jack from Square and Twitter, they could just walk in to any venture capital firm and say, I have a new idea, and they'd probably give them a $5 million check for a Series A for 25% of their company. That's one of the great things about our industry. If you have a track record, you're going to be able to raise money easily. But for everybody else, you have to prove it. And you have to have angel funding, syndicate funding, and revenue, and have built up to that point. So yes, you don't want to try to meet with VCs before it's too soon. You need to know when is the right time to meet with the VC. The right time to meet with a venture capitalist is when your company has some significant level of traction. Do not contact VCs before you hit serious traction. Serious traction in our industry here in Silicon Valley is going to be $50,000 to $100,000 a month in recurring revenue, and it's going to be 10 to 100,000 people using your product a day and a couple of million people a month using your product for a consumer product, right? So consumer products that'll be ad supported, like an Instagram or a YouTube. Yeah, they don't need to go to a VC until maybe 10,000 people a day, in my estimation. Now, one thing I will disagree with is to stop meeting with associates. Now, associates are the people who are hoping to be venture capitalists someday, and they do a lot of the grunt work for a VC. And a VC might say to them, hey, just watch these emails and pitches coming in and put them into our database and sort them and categorize them. Associates have no decision-making power, but associates do have the ear of venture capitalists. So if an associate, who's typically a younger person starting their career, would be a millennial or maybe even part of Generation C, the connected generation, or Generation Z, as I've heard them called. A lot of times a 40 or 50-year-old VC might look at their 25 or 30-year associate and say, you know what, he or she might have insights into how the kids are using Snapchat that I don't have as a married person living in Woodside in a $10 million house, like a venture capital might be doing. So those associates can actually be some group of people that you want to build a relationship with. Now, if you get escape velocity and you're a serious entrepreneur, you would never even talk to these associates. You're not going to be involved with them. You're going to be talking directly to the partners. But if you're up and coming in your career and you've got an angel-funded company, and let's say you're below the traction level I talked about earlier, maybe you're at $10,000 a month in recurring revenue, maybe you're at 5,000 people using your product a day, sure, go meet with an associate. What I like to do is challenge them. We're not fundraising now. However, if you would like to come meet the team, we'd love to have you come over. Not going to their place, just saying, hey, we'd love to have you come by and see what we're working on if an associate reaches out to you. But these associates sometimes just email everybody in a category, everybody who graduated from a recent incubator, everybody who was on TechCrunch, everybody who's on Recode, everybody on the top 5 on Product Hunt. Their just job is to put those all in a database. So you can be getting snowed by those associates into thinking, oh my God, they contacted me, they're really interested. Their job is to create a full picture for the venture partner. So yeah, you're just part of the full picture. You might be the bottom 10% of that full picture they're presenting. So you do need to know cold emailing people and setting your deck around without actually having somebody ask for your deck. Yeah, that's probably a little bit silly too. You want to be referred to somebody. So if you can't find out who are the entrepreneurs who I've invested in, there's 150 of them, and you can't get a meeting with them to say, hey, can I show you my product and get your advice? And would you mind introducing me to Jason? Or you can't look in your LinkedIn or Twitter and see who I interact with and try to find a way to find somebody who knows me who will vouch for you and then introduce you. You're probably a bit of a loser. You probably don't have what it takes to be a founder. You need to have that hustle and be able to work the network. And if you're not in Silicon Valley, you should not expect to get coffee with a Silicon Valley person just because you have an idea. That's another one of the huge mistakes. I have an idea. I have a business plan. Can I get coffee? A lot of these investors are very busy. They have families. They've got boards they're on. Time is the thing they don't have a lot of. They only want to talk to you when you have traction. So I think you have to know your audience as well. If somebody is an angel investor, their benchmark for a meeting is going to be lower. A VC, the benchmark is going to be higher. An associate is going to be somewhere in between. So there is a time to focus on just the VCs and just getting introduced to them. And there's a time to be cold emailing angels, sure. And Christopher's company is hardware-based. Hardware is hard. So one little tip for Christopher on the hardware tip is if you haven't done pre-orders and if you haven't done a Kickstarter, Indiegogo, or something to that effect, or your own crowdfunding tilt campaign, you should probably do that because all of the investors look and see, hey, have you gotten any validation from the public? And have you put the sweat equity in to get 1,000 pre-orders? If you can't get 1,000 pre-orders, why are we even talking about investing in this idea? Come up with another idea that is worthy of 1,000 pre-orders. So when I saw that Butterfly and Birdie were able to get hundreds of thousands of dollars in pre-orders, that engaged me as an angel investor. Now I would expect to see $500 or $1 million in pre-orders, and even then I might not be interested because hardware is so hard. Hardware is just a lot of scar tissue. People hate hardware investments. Okay, great question. I hope that's helpful. Hey everybody, you know how much I love Wistia. You know how much I love having control of my videos and how they're presented and the ability to grow our mailing list at This Week in Startups. So when you go to thisweekinstartups.com, you're going to see we use a product called Wistia, WISTIA, wistia.com. Go to wistia.com/twist and you'll get a free account and you'll start hosting videos in minutes. Now, why is this so important? It's so important because you need to control in a business setting or in your podcast setting, you want to control the experience when people watch your video. You don't want wacky annotations, all kinds of ads layered onto it, cruft, garbage. And you certainly don't want your competitors' videos coming up and suggestions all around it. You want to control your experience and have a beautiful, clean experience that allows you to do high-end marketing techniques like put videos behind a paywall or a password and to get people to sign up with an email and give them that prompt, hey, want to get the next episode, come to the launch festival for free, put your email in. Hey, want to get a white paper? They have over 330,000 using Wistia now. When they started on This Week in Startups, just like 2 or 3 years ago, they only had 50,000. So this company is growing amazingly. I mean, I wish I could be an investor in it. They are crushing it. And you get great analytics, trends, viewer streams. You can really see like, oh, people are rewinding the video and watching this section twice. I always find that fascinating. And as I said, it's super easy to use. You have tons of support. And one of the things they do great, and listen, you can go look at this for free. On their blog, they explain how to use microphones, how to use cameras, how to edit, how to make great content. All because they know that if you're coming from a business situation, you may not have made video before, but your consumers are demanding video and they want video on a regular basis. Video is the best way to communicate. You're hearing my voice. You're seeing me on thisweekinstartups.com. You want to watch videos when you come look at a product, service, or any website, you look for the video first, and Wistia is going to help you make and serve those great videos. They integrate with all the major email and marketing automation tools. Clients include MailChimp, Moz, HubSpot, Zendesk, Herman Miller, Sam Adams, and of course, This Week in Startups and Launch. We love it, and get their guides to build using the right microphones and lighting and setup and all that kind of stuff. It's really great hacks. Wistia.com/twist. I love this product. Go use it. Okay, let's get back to the program. Okay, another great question. This one is from Patty Brown, and she asks, "Hi, Jason!" Exclamation point. It is difficult to have everyone sign an NDA. When should you really protect your idea? When should you just go with it? In the venture community, in startups, investors don't sign NDAs. We see too many ideas, and we can't be beholden to every crazy idea we hear and signing an NDA and opening ourselves up to potential lawsuits. That's not because VCs are largely going around taking your idea and they've got 1,000 entrepreneurs sitting in a room waiting for an idea, and you bring the idea to them and say, this is an incredibly clever idea. Let's take one of our entrepreneurs off the shelf and have them execute it and beat this person. The idea is not typically the hard thing. It's the execution. So the idea that NDAs are necessary is kind of silly when you're in the angel investing stage. They are more serious when you're doing partnerships with people. So if you were going to do a partnership and you had a new product launching like Apple's watch and you wanted to have 10 apps on the watch, yes, you might go to a company like Uber or Slack and say, hey, do you want to build Slack or Uber for the iWatch? And one of them says yes. You say, okay, we're going to have 3 people on your team sign NDAs. They're going to come to our offices on these days, and you're never going to get to actually see the watch but until 10 days out, but we're going to have you come and do testing, and we need each of those people to sign an NDA, and they're very serious about it at Apple because they want to have a surprise when they launch it. Almost nothing you have is all that proprietary. That's the truth. Now, there are things like your growth secrets, little secret weapons you have in terms of how you operate your business. Let's call them best practices. So if you find out, oh my God, if I just go to search on LinkedIn for this title and I email that person, 8 out of 10 of them take a demo for my enterprise software, and out of those 8 out of 10, 3 of them sign up. I have found the magical title to search for on LinkedIn. Well, yeah, you don't need to write a blog post about that and give it to your competitors. That's a tactic, and those tactics you should keep close to your vest. You don't need to explain your tactics everywhere you go. And have there been instances where information from one venture capitalist that you've given to a venture capitalist has gone to another company? It's possible, but it's not probable because VCs' reputations are very important to them. They're in it for decades. They don't want an entrepreneur going around saying, you took this idea and gave it to another person. In fact, some VCs will say, oh, you're pitching me an on-demand company? I'm already an investor in Instacart. We probably shouldn't meet because I don't want you to feel this way, even though it's not likely that your idea is going to be stolen or any of your techniques will be stolen. It's just they don't even want to have that mess. So VCs are highly aware of it. What does happen in terms of espionage and people trading in information is people will ask your employees to come for a job interview. So you could have the people at Instacart decide to interview people for jobs from, I don't know what's an Instacart competitor, but, Amazon Now or something, and they might interview each other's employees and try to pump them for information during the interview process. I have heard of that before, and that's kind of dangerous. And there's very little you can do with that other than NDAs with your employees and making sure that they understand what confidential information is. And that's just a candid conversation that your HR department has to have with each employee for them to understand that do not tell anybody what we're working on. Do not tell anybody who our customers are. Do not share tactics that we do here. Do not put it on social media. Do not explain anything to anyone, even casually in a bar, because you don't know who's overhearing you. And companies like Apple have been very good about, hey, loose lips, sink ships. Do not talk about what we're working on here. So there's NDAs that can go all different directions. Usually NDAs work best between partners who are launching new products? Great question from Patty. But don't worry about the NDAs with investors. It's completely unnecessary, and it makes you look like a rookie who's never been around town. If you go in and say, I'll meet with the VC, if you sign an NDA, the VC is going to say, we don't sign NDAs. It's just silly. Okay, great question. Okay, Leo is an inventor, and he says, it would be better if I filed a patent before I present my project to investors, but I don't have the money for a patent lawyer. What do I do? So I do think that some people have figured out how to file patents on their own. I don't know if that's particularly a good answer for you, but if you are that creative of an inventor that you can come up with something truly unique in the world, you should be able to figure out the patent system or how to do consulting to make enough money to have a firm do it for you as a deferred payment. So if you go to any of the top firms in Silicon Valley and say, listen, I have a great idea. Here's what it is. I would like to cut you in. I'll give you some equity. I want to trade a little bit of equity, and I want you to do my patents instead of for $20,000. I want you to do them for $4,000. I'll pay you the $4,000 in cash, and I want to just give you the $16,000, and I want to do 4 patents, so I want to give you $65,000, and I'll give it to you times 2 at whatever. I'll give you 3x that in convertible debt at the price round. So I'll give you $200,000 at the price round, or whatever it is. You can negotiate any type of deal. If you can negotiate a type of deal like that, you'll be surprised that some firms will do it because they know that if they help you, you're going to use them for some time to come. It does depend on how good your idea is and how unique your patent is. Patents don't drive our industry all that much. Patents are like nuclear weapons in the technology space. Nobody wants to use them, but you have them so you can show them, hey, look, I've got some patents. If you fire one of yours, I'll fire one of mine, mutually assured destruction. And generally, you don't see too many patent lawsuits. When you do see patent lawsuits, they tend to go on for a little while and then get settled. So you'll see Samsung and Apple and Oracle and Google. It gets very personal. They're vendetta based, like Steve Jobs or Larry Ellison feels wronged, and they just are going to go to bat forever to fight against these companies. And then they wind up getting settled. So I think patents are one of those things that people maybe obsess over too much, especially the business ones, which are kind of hard to protect anyway. And most of the great businesses out there were not built off patents. They raised venture capital and then started protecting their patents. If you have unique IP, you can just keep it close to the vest and then patent it after you get funded, or patent as you go. A lot of the great companies I've invested in did not need to have a huge patent portfolio. And if they did build one, it was for nuclear weapons purposes in all likelihood, just to defend against somebody else filing the patent and then coming and claiming they stole it. But a solid question, work on the business model, work on building a team, work on a revenue stream. Those are the things, the product, the revenue, the team, that an early angel investor will make their decision based on, not the patents typically. All right, here's a Facebook question from Joanne. She asks, what's your best advice for a female founder to make sure she is taken seriously when she pitches her idea? Great question. And in that is this, implied concept that women are not taken as seriously in startup land. I don't know if that's the case anymore, but I have a feeling, sadly, you're probably right. So I think it's changed a lot. And I think people are actually super open and actually trying harder to meet with more female founders and to meet with more underrepresented minorities. URM is the industry term in our industry, technology, to try to increase the diversity in our industry, because diversity is strength and a lot of great ideas. You probably have some blind spots. You're not going to understand some markets that might be huge. So I think having, just in general, to be taken seriously, I think getting introduced by the right person, having the ability to control a meeting is also very good. Not have founder pinball take over. What I call founder pinball is when a founder wants to please the audience or the investors, and I have this right now with a male founder who is just basically like doing tickets from one of the investors. Like the investor keeps coming up with ideas, and the founder is just doing what the investor's ideas are. And these are throwaway ideas that are coming over text message. Like, that's not how you run a company. You should have a strategy and a plan. So what I like to see is, and I've seen this actually happen on stage at the Launch Festival and other times, is controlling the meeting and controlling the question and answer. And when you disagree with somebody, you can say, Jason, that's an interesting observation. In this case, you're actually wrong. We have a lot of experience in the space, and although you may think that the amount spent on this category is X, it's actually X times 5 if you take this into account. So it may seem wrong to be confrontational with somebody you're asking to get money from, but what I found is I love when I get pushback from a founder because I'm going to pepper a founder with questions. I know that I'm not right on all of them, and I might have some ideas. And having the founder say to me, we thought, and this is a nice way of saying it, we had the same idea. We tried it 6 months ago. It didn't work for these reasons. Our customers told us they didn't want it. But we did have the same idea you have, Jason, and it didn't work. So we have a testing methodology. We use the lean startup methodology. We like to test our ideas. And so it's not being confrontational, but it is sort of taking that approach of, I understand your question. I think that this is not a great idea, and we don't want to pursue a consumer play. We want to be business to business, or we are a consumer company, not a business-to-business company. We think the business-to-business opportunity is much smaller. We would like to pursue the business-to-consumer. So don't be meek. Don't be weak. Practice your Q&A. This is another thing. I do it in my incubator. I practice Q&A. And again, I don't think this is gender-specific, but I will meet founders who are passive and meek. And when somebody asks them a question, they might be really introverted or considered, and they might want to think about the question. And you know what? It comes across as weak. That's just the dynamic that happens in a Q&A session or in one of these meetings. So it's okay to be considered. It's okay to take your time in answering. But I like forceful answers. I like strong answers. I like fact-based answers. And when you don't know, I hate when people are BS artists. So if somebody says, what's your retention? And the person starts answering some completely other question, the person should just say, I don't have that handy right now. We just launched the product 60 days ago, but we'll have retention data probably in month 3 and 4. We literally just put some software on to track retention, and we'll have that data in the next 30 days. We'll get that to you. That's a better way to say it than going and freelancing and just completely going off on a tangent. So being precise with language, being a little confrontational, being strong with your answers, and being able to mix it up a little bit as an entrepreneur, gender, independent is important. You might see that more in females slightly, but to be honest, I think there's a self-selection that goes on right now that the women who actually choose to be entrepreneurs tend to be very strong. And so I have to tell you, like the women I've invested in, on average, are stronger than the men. I know that sounds crazy, but or maybe it's just my selection of the women I've invested in, but they are stronger willed and stronger personalities than, on average, the men I've invested in. So getting to understand those differences is also part of how investors can be better. So I know that, I think, because I'm an extrovert, probably was more attracted to the extroverted founders. But then I read this book, The Power of Introverts, and I started thinking about some of the smartest people I've met, and they're slightly introverted. And I started thinking, wow, Zuckerberg, Larry Page, kind of introverted people, change the world kind of people. And yeah, you might have extroverted people like Steve Jobs and Larry Ellison who are more brash, and then everything in between. But I thought that was a little bit of a leak in my game. Like I had a little bit of a leak in that maybe I preferred, the bombastic, confrontational CEOs. So I've actually corrected for that. And I when I get the sense somebody's an introvert, I actually give them more time to respond, and I back off a little bit, and I give them a little more room to breathe, if that makes sense. And then I don't fire questions at them like I might volley back and forth with a highly extroverted person. So it's a great question. And I'm very encouraged as the father of 3 daughters and the son of a great mom and the husband to an amazing wife, that I am seeing many, 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 many more female founders. And they're awesome, and they're strong, and they have a sense of purpose, and they work hard. They just work so hard. And I think they take the work more seriously than men on average. Again, that's just my experience, but The women who are doing startups take it super seriously. Like they don't have time for goofiness. They're not going to the Web Summit or the cruise or the Summit at Sea and this other nonsense to blow investor money or try to get speaking gigs at TEDx or other nonsense that have no actual impact on their business or any return for their investors. So I love the focus level I see women bring to startups. And that's why I think there should be more women in startups, frankly, because the focus level is off the charts. Okay, anyway, I probably got myself in a ton of trouble with that. Anytime you talk about gender differences, people get really uptight, which is understandable. It's a touchy issue. Okay, here's another question. This is from Pablo. And he says, in the 150 plus investments you have made, what have you learned works in choosing winners for you? Great question. This is a moving target because I'm constantly learning. I have learned over time that people capable of doing great work show that great work very early on. People who are not capable of great work show industry statistics or meetings they may have had. But the truth is, the great companies, the great founders, the great founding teams are able to produce great product. Now, it doesn't have to be perfect. Usually products in their first year are awkward. They look weird. If you look at the early version of Facebook, Twitter, Uber, even Google, they were clunky. The Google logo was ugly. The website design was terrible. And that's become one of the most important businesses of our time. So where these startups start in terms of how they look and feel on a product basis and where they end up is very different. Somewhere around the second, third, fourth year, they probably get the resources online to actually make the product better. But what a lot of angel investors do, and I've made this mistake myself, is they look at what the startup could be, not what the startup is. And the best way to tell if somebody's good at something is to watch them do the job. And so there's no rush to invest. If you meet a company in month 3, you could probably invest in the next 3 months, the next 3 months, the next 6 months, the next 12 months, the next 18 months. So getting to know the company, taking 2 or 3 meetings, and looking at their progress between meetings, what's changed. A lot of times I've seen a startup that has not changed in 3 months. And I go, what's changed? What's new? What are you working on? How is it going? And they have no new updates other than, we got a meeting with this person and we won this hackathon and we won this pitch contest and we applied to Y Combinator and we applied to 500 startups and we got a meeting at YC and we got a meeting at 2 meetings at 500 startups. None of it to do with the core business. Then you meet people who say, yeah, we released our 1.1. We were able to get 500 people in the beta. 100 of them converted to paid. Of those 100 that converted to paid, 20 of them churned, so we have 80 left. And they all of a sudden start rattling off these statistics about the core function of the business and making money and or engagement. Businesses tend to have some core metrics that drive them. And if you look at Facebook, they knew after you had like 3 or 4 friendships that they would have you for life. They knew that once they hit a certain percentage of a college campus, they would get the entire college campus. So all of these businesses the good businesses discover something like that, some liquidity in their market, some nuance to their product. And the entrepreneurs who just talk about things that don't have to do with the core metrics and the core functionality of their product, that's a bit of a tell. And I have made that mistake before. And in the investments that have worked out, it's almost universally been a founder who is obsessive in building out their product, especially in those early days. So when Marco showed me Thumbtack, there was so much craftsmanship to Thumbtack.com in the first version, which has nothing to do with the version that broke out and became a huge hit today on mobile, but the desktop version just had a lot of craftsmanship to it. And when you see somebody build something with craftsmanship and with a certain deftness and they understand their business model, you start to feel that credibility over 2 or 3 meetings. And then when you hear somebody who's just a talker and they're not building anything, you can immediately cross them off your list as a potential investment, because in this industry, it's so easy to build product now. It's so easy to get a beta to market that if you don't have your product in market, at least a test of it, then why are we even meeting? Why can't you accomplish the basic task of pulling together $25,000 in resources to get an MVP out? If you can't get a $10,000 or $20,000 or $30,000 MVP out the door with your own sweat equity, something is wrong. You're just a talker. You're not actually ready to be an entrepreneur. And these people have to wait to find a developer, and they're constantly looking for new developers, and they can't move the product forward because they're not a developer, their co-founders aren't developers, and they don't seem to know how to find developers or how to outsource. These people never work out. They never work out. They're constantly waiting to get there. And there are some people who are just extraordinary at raising money and terrible at executing. That's another thing I see a lot. So I've learned a lot. I think it's probably my best gift is to be able to look into somebody's eyes while they're talking and quickly determine if they have deep passion and need to see this product in the universe. And sometimes I'll just look into somebody's eyes and I can tell that they actually themselves don't believe in what they're building, that it's not very important to them. I need people who are just absolutely feel like what they're working on is the most important thing in the world to them, and there's nothing they would rather be doing. That this is their nirvana, this is their cross to bear, this is their mission, and that they will fight to see this realized. And it's so obvious when you're talking to somebody and you say, why are you doing this? They say, well, we think that there's a huge market. That's really not a great reason. You know, if you're building Tesla, it's because you want to get the world off of carbon-based energy and move to sustainable, renewable energy. That's what Elon always said. Like, it's not about electric cars per se. It's about getting off of fossil fuels and moving to a sustainable energy source. Sure, the product is a car, and he was obsessive with the details of the car, but he had that big vision, and he was passionate about it. So you see that over and over again. But when you're an angel investor, you very quickly learn to forgive yourself for making mistakes, because the wins greatly outweigh the losses in terms of return. The sheer number of losses is high. 7, 8, 9 out of 10 angel investments I do will go to zero. That means the 1, 2, or 3 out of 10 that do survive have to return, 10x, or in some cases, or 5x, or 6x, just to hit break even. So I got a lot of work ahead of me. When I have something return, I just had an investment like Trello return 9 or 10 times our money. It feels great, but that's going to make up for, another 7 that return zero. So I need to hit another one of those in order to have a return. It's not easy being an angel investor, and you have to learn as you go and not beat yourself up too much about the mistakes. But good question. Let me tell you about a product that is not pathetic, but solves a lot of problems in my house and many of my friends. I was talking to some of the Engadget bloggers and founders, and they love this product too. It's called Eero. E-E-R-O. It's the world's first home mesh Wi-Fi system. It is mesh. What that means is they connect to each other, and they do that fast. And with a simple iOS or Android app, Eero will blanket your home in Wi-Fi coverage. You want to buy one of those triple packs so you can put it everywhere. And the first one replaces your existing router. You know what you have connecting to your cable box, your fiber if you're lucky enough to have that. And then the additional Eeros just simply plug into outlets, and they connect wirelessly for fast, reliable Wi-Fi for the entire home. I have used it. I love it. It sets up so easily, and it kicked the butt of the previous routers I was using. And I think I can mention them because they're discontinued. There's another thing Apple discontinued was their Apple airports, which constantly did not work for me and were a source of much marital discord. Literally, when my wife comes walking up to me and she's upset, I'm like, oh my God. There's like one of 3 things she's upset about. 1, I let my daughter eat candy. 2, I left a mess somewhere. 3, the Wi-Fi's down. No more. I got rid of 1/3 of marital discord is gone because of Eero. Go ahead and visit Eero.com, EERO.com, and enter the promo code TWIST, and you will get free expedited shipping. You're going to get it really quick. Go to Eero.com, EERO.com, and put in the promo code TWIST. It's incredible. It's amazing. It's simple. That's one of the best things about it is it's so simple to use. I love it. Go ahead and follow Get Eero as well. Use the promo code TWIST. Very important, use that promo code so that our partners know that you actually heard about it from Uncle Jason. Okay, we have another question from the Facebook live stream. It's from Matt. And Matt says, hey, I need advice for our company that's completely bootstrapped. Great. You built it off of revenue or sweat equity. And he says that they've had some steady growth. Okay, there's a qualifier there, some, over the past 12 months. But you now need funding to scale. Good. There's a term that investors like to hear, scaling. Somewhat crowded space. That's something we don't like to hear as investors. But we have true innovation that none of the competitors are addressing. Okay, another red flag for me. So I'll tell you, just reading this as an investor and as an entrepreneur, I look at it and go, okay, I'm a little concerned because without knowing the exact details, you were able to quickly bootstrap this, which means there's a market for your product probably, and you've had some growth. Another indication that there's a market. But perhaps this market is saturated, because if it was so easy for you to get into it and bootstrap and have some steady growth, but it's so crowded that you need to have some innovation, you might have a pricing power problem, which is if there's 20 people offering the same software, nobody can offer too much, or you can be undercut for it. Or you have 12 people splitting $100 million revenue stream, and everybody makes $8 million, and it kind of sucks, right? So I'm a little concerned there, but a good investor should be able to tease it out and tell you if they think your problem is competition or if what you have is truly innovative. And that's where, if it was me, I would start to look deeply at the engagement in your product. Is this product driving massive engagement? And what is the NPS score, Net Promoter Score? Make sure you're recording that from the early customers. Do they truly love it? Are they telling their friends about it? And if you email them and say, hey, would you tell your friends about this product? If you get a friend to sign up and they get a free month, they'll get a free month and you'll get a free month. Does that kind of thing work? In other words, would you actually tweet to get a free Uber and so you could get one, or get a free night in Airbnb and give one, or $20 coupon, whatever Airbnb gives? Those kind of things become a real test to see if people truly love your product. So I would start looking at that. But here's the question. Does it make sense to go after investors in the space, or go to just anyone with a check in order to really build out the product fully? So I would say you would do this in sequence. If you can get the best investors in the world, you start with them. If the best investors in the world, the Sequoias, the Benchmarks, the Social Capitals, say no, then you can go to the next tier. And I won't say the next tier because I don't want to make anybody's feelings get hurt, but there is a second tier of venture firms. And you might go to the next tier of angel investors. Oh, you couldn't get Chris Sacca or Cyan Bannister or Jason Calacanis to take a meeting, but you got the next group of people who would take a meeting? Great. You can just go down that line and just look at what their track records are. The people who have the massive track records, in some cases, actually are very open to meetings. And the reason they have a great track record is because they meet with a lot of companies. So that's a little counterintuitive, isn't it? But you can do this in a stacked order. And taking money from people who are in the category of just anyone, be careful. You want to make sure they're qualified investors. You want to make sure that they're not putting too much of their net worth into one company. So I've heard about, in my years here in the Valley, 3 or 4 times there's been an investor lawsuit in 20 years of me being in the tech industry. Theranos obviously has 2 going on right now from what I read in the paper. But I've heard of other ones where, I know one specifically where they had a very high profile investor who was one of the most top 3 notable angel investors in the world. Not me. Not Chris Sacca. You can work backwards now. And after they had that notable investor, they had somebody who was a woman who had inherited a bunch of money, and this person had plowed $250 and then another $250 into the company, and they thought it was a sure thing. They thought if you invest in a startup company, at some point you're going to get some return. It's just a matter of what the return is. And then this person realized, oh, I didn't diversify. Oh, I should have taken my $500,000 and put $25K into 12 companies, and then put the final $200,000 into the top 2 companies, and had some sort of portfolio strategy here. And that person actually sued, and it became a whole brouhaha. It was what do they call it? A Donnybrook? It was not fun for everybody involved. There were a bunch of threats of lawsuits, perhaps even lawsuits, and that's not fun. So you have to be careful. When you take the dumb money, what they call the dentist money, rich dentists, it can be a disaster for you. So be very, very, very careful. It is a dangerous thing to do, to take that dentist money. And if you do take it, you have to say to the dentist, is this your first startup investment or have you done many? How many have you done? Do you understand that these are high-risk investments and that the majority of them go to zero? And are you okay with that? Can you afford to lose this money? Now, that sounds like a crazy thing to say because you don't want to scare them off, but you also want to make sure you're dealing with somebody who can handle the risk. It is not fun to have investors who don't know how to handle a loss deal with that. And there's been, this has happened a couple of times in history, and I say, be careful. Okay, we'll do another question. This one is from Sergey, I'm assuming not Bryn. And he says, how much time do you commit to helping your portfolio companies directly? That's a great question. And I'll extrapolate it a little bit. How much time do angel investors spend with their companies? How much time do investors spend with the companies they invest in? There's different type of angel investors. There's different type of venture capitalists. Angel investors typically invest, and they're available to talk to the founder and email with the founder as much as the founder deems necessary, as much as they want to. I try to not bother the founders. I try to not be over their shoulder too much. They have to run the company. I am but an investor, and I'm there as a resource to be used for things like introductions or discussing strategy, maybe in my case, discussing marketing and getting attention for a company, which happens to be one of my specialities. But each angel is different. Some don't like to meet in person. Some don't like to talk. What I like to do, and which I now require of anybody I invest in, is that they agree to do a monthly update. I've been actually putting this in the documents. We just expect a short monthly update from you. It's 12 times a year. If we're going to give you money, just give us a short update every month on how the business is going. And since we started doing that, the monthly update is so powerful because when I get it, I can read it. I feel comfortable with where the investment's at. I feel like I know what's going on. And maybe I'll read something in there and say, oh, they're doing a deal with IBM. Oh, they're trying to get a meeting with Cisco. I know people at those two companies. I can help. And I can hit reply and help, or I can just lurk and read the updates every month. And maybe in month 3, I'll have a comment to make. So that's a great way for one founder to send to many, one-to-many communications and expect some number of people to reply back. I'm not going into the companies and visiting their offices, meeting with their team members, doing strategy, et cetera. If a company needs somebody to come in and do that for them, that's a bit of a problem, isn't it? Companies and entrepreneurs need to be independent. And so if you're investing properly as an angel, companies will not need you to come in and do the work for them. They're going to need you for introductions and advice, and you want to be available for that. And so I'll check in with companies once in a while. I'll have companies go dark on me for 6 months, and I'll ping them every month. Hey, do you have an update? Hey, you have an update? Hey, do you have an update? Hey, do you want to get coffee? And then finally they emerge, and it's either that their company's dying and they need more money, or it's dead already, or it's been doing so spectacular they've been heads down. In both cases, you're much better off staying in monthly communication with your investor base. And your investor base, they should tweet for you, maybe do a share if you're looking for a position, forward on a job to somebody you know who might be qualified. Each angel's different, and as an entrepreneur, you want to collect a group of investors early on who can have a varied skill set, almost like the Avengers. You send the Hulk in to solve some problems, you send Black Widow in to solve others. The Hulk is not going to be a very sophisticated solution when you send the Hulk in, but the Black Widow might be a very deft, quiet way to, exterminate somebody as opposed to the brute force of the Hulk. So pick and assemble your own team of angel investors like the Avengers. Different skills for different needs you might have. Great question.